Good morning once again, options traders, and a very special welcome to, we've had a lot of people sign up this week, so it's great having you in the group. And I wanted to talk a little bit about a resurfacing myth that I'm hearing a lot, especially during coronavirus, what I call the 66% chance myth. And it has to do with the fact that stocks can only go up, down, or sideways. And it leads people to believe, for the wrong reasons, that they have some kind of a magnificent chance of winning and making money by selling naked puts. So here's the logic that they use. Again, they're saying there's three ways to win or to make money. And again, it's based on the fact that there's only three things that a stock can do. It can go up, it can go down, and it could go sideways. And so again, what they'll say is, because of this, if I sell naked puts, I can win 2 out of 3 ways. And that implies a 66% chance to make money. And so they think it's the be-all, end-all strategy because they've got some kind of a high probability for success. So this might not make total sense to you if you're new, so let me show you graphically what they're talking about. So here's our profit and loss diagram for a $50 call. We've got our bend right here at the strike. So let's say that the stock is at 50 and you buy this $50 call for 6. Your break even is 56, which is found by adding the strike to the premium. So we need that stock to be at 56 at expiration just to get our money back. So what does that mean? It means the only way you're going to win is if the stock rises. You absolutely need it to move. And so in technical terms, this is because when you buy an option, whether it's a call or a put, you have positive gamma. So this is our risk graph here in red at expiration, but this is not how the option behaves today. Let's say there's 30 days till expiration. This is what your risk graph looks like. It's going to be this curved line. We read it the same way as we do the red one, but we're just going to read it off the blue. But notice that it is curved. And specifically, it's kind of pushed in from the top here. So it kind of looks a little bit like a smile. And this is very indicative of positive gamma. And what that really means is that if the stock price falls, notice that we are subtracting off our deltas. It's like we're selling off shares. We're becoming less sensitive. And it's starting to save us from further losses. But if the stock price rises, we start adding deltas. We start adding to our stock position. Well, that's obviously a huge benefit. And because of that, you have to pay for it. And that's why we need the stock price to move in order to make money. So again, that's what they're talking about when they say there's only one way to make money if you buy the calls. Same idea for the puts, just to the downside. However, under these same conditions here, if you had instead sold the naked put for 6, what's that going to do for you? Well, now your break even is at 44. For puts, we find that by taking the strike minus the premium. So I could have the stock fall all the way down here to 44 and just get my money back. And of course, if the stock rises, I can still make money, albeit limited, but it doesn't hurt me if the stock rises. And it doesn't really harm me if it sits right here at 50. I'll still make my $6. And I can still make something all the way down to 44 where I just break even. So that's where they come up with the idea that you can win or make money if the stock goes up or sideways. So it's important to understand when they say sideways, they're not talking about dead still at 50. They mean just floundering around here in kind of a narrow range, and we'll still probably be okay. So if we look at our risk graph for today, it's going to be curved, but notice we are actually pushed in from the bottom. This is a characteristic of negative gamma. So it just means that as the stock price rises, we're not buying more shares, we're selling them. We're fading the market. And that's why we're starting to flatten out up here. And if the stock price drops, we're actually adding to our position. We're buying shares on the way down. That doesn't necessarily mean that positive or negative gamma is good or bad. They're just different. So this is what they're talking about when they say we can win whether the stock goes up or sideways. So again, because a stock can only go up, down, or sideways, and you're winning in 2 of these 3, does that really imply a 66% chance to win. No, it does not. This is just bad logic. It's bad math. If you want to use this logic, it would be the same thing as saying, well, you know, in the lottery, there's only two things a ticket can do. It can either win or it can lose. So there's only two things that can happen. So if you buy it, therefore you have a 50% chance to win. Well, we know that's not true. If you don't believe it's true, try playing the lottery for the next couple of decades. You'll find that you'll never win. Okay, the chances are far more likely for you to lose. It is not a 50-50 shot, even though we could look at it in that there's only two things that can happen. So in the stock market, remember that stock price changes follow a bell curve, roughly speaking. And so just because you might apparently have this edge when stock prices sit still, it's minuscule. So I've shown this before in a previous video, but let's say that you flip a coin 100 times and somebody says, what's your best guess as to how many heads will show? Well, it would be 50. Does this mean that you have some kind of a huge edge of winning just because it's the best guess? See, it sounds like it. If I say it's your best guess, people assume you're going to have a high chance for winning. Well, this is what the distribution looks for 100 coin flips. So to get 50 heads right there in red only happens 8% of the time, which means you're wrong 92% of the time. So hardly an edge, even though it technically is still your best guess. But there's still a lot of room for being wrong. So remember that. Stock price changes move according to a bell curve like we just saw with the coin flips. And so yes, you do have this little segment here where the stock price sits still that you could make money. But that doesn't necessarily mean that it's jacked up your percentages of winning up to 66%. The better way to look at any strategy is to look at the delta. And the delta of an at-the-money call or put is about 50. So really from a larger perspective, you've got about a 50-50 chance of winning or losing. Well, now that raises a question, well, then what's the big deal? If I might have this little tiny edge where I can win if it sits still, what's the problem? The problem is the risk. So here's a real good example. End of last year, Eagle Bank Corp. And you can see here at the end of 2019, fell from about 53 down to 38 in a single day. That's a 28% drop or 15 points. So yeah, back in here, you might have thought it was a good deal while the stock was rising to sell these out-of-the-money puts, but because they weren't really worth that much, you do it 10 times, and then you get hit with this. They're now 15 points in the money times 10 or $15,000. So yeah, congratulations, you might have picked up $150 or $200. And in fact, you might have been doing it successfully all through here for a long time. But it just takes one day, just one. And the broker's going to say, can you meet the maintenance call right now? And if you say nope, they're going to say, we're closing you, shutting down the position. And you might say, but we know about gap filling. We know that there's a good chance it's going to bounce back from here. Broker's not interested in speculating with you. If you can't meet that maintenance call, they're closing the position now. And when I was on active trader options, I saw this a lot of times. People going negative equity, 50, 100,000, 200,000 and 300,000. And that means you have to send that money to the broker just to get your account to zero. And if you don't meet it, it's going to go on your credit report. They're going to sue you in court. And for the rest of your life, you're going to be paying on that for something that you thought was a good idea. So that's why I always tell traders that unless you have a much bigger reason for using naked put, such as, yes, I've got the cash on the side, and if I get assigned, I'm going to buy the shares. That's one thing. But it's an entirely different thing if you're selling naked puts on stocks you don't want to own just because you think you have a 66% chance to win. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.